we say in the company, there are more checks that we've received from growth capital investors than probably any other private company in India. But the sad fact is that somebody is very methodically killing off growth capital in India. And with your help in the next 5 minutes, I hope to kind of catch the killer. It's one of these guys. The financial crisis, the government, corporate India, intermediaries, investors themselves, and entrepreneurs. So these are the prime suspects out there. And the optimistic scenario, we'll get to that, is, it's still alive. Right? The evidence is quite overwhelming that, somebody is out to kill private equity in India. If you look at this slide, what's happening is that in 2006, number of investments made by private equity investors in India is 299, of which subsequently they've managed to exit 190 of them, which leaves 109 more investments yet to be exited, and this is now 2006, 8 years since, right? 2007, even bigger towers, on the unexited portfolio. And adding up just between the 4 years, 2006 to 10, 1,000 plus unrealized investments, that are kind of yet to be exited, quite grim. So as a result of which, the LPs are kind of clearly voting with their feet, right? No new significant size funds have been managed to raise in the last 3 years. It's just one way downwards in terms of new funds raised. So the message from the LPs is quite clear. We need to see some dollars out before we put some more money back in. So as a result of which, the impact on new investments, again, it's just one way down. Entrepreneurs are viewing less, seeing dollars flow their way. In the last 3 years, it's all been down. So the vital signs of the victim, which is growth capital, is not very promising. So who's really done it? The financial crisis, but for the financial crisis, all private equity backed companies in India would have probably gone IPO. So can I probably have a show of hands as to how many people believe the financial crisis is responsible for death of private equity in India? Right? Very few. And this is the usual suspect, the government, or the lack of it that has caused the death of private equity in India. So any votes for, the government did private equity in India? Next suspect is, corporate India. Neither do they buy companies from private equity portfolios, nor do they buy anything from the, the products and services. We prefer to buy IBM, right? The intermediary, this is again a classic suspect that a lot of investors seem to point to. These guys are just in the auction business. They drive up valuations and ensure that, private equity investors are left holding the bag, and, so in the new case being, 3 years down the line, they will probably identify another investor to replace the existing investor. Any which way they make the fees. So they always win. Next suspect, the investors themselves. This is a very cynical, view, which says that the business the private equity fund managers are in is to kind of go out, raise a bunch of money, put it out as fast as possible, right? And people talked about 2 and 20. They care only about the 2. Put out the money, raise fund 1. Don't wait for any exits from fund 1. Do fund 2, fund 3 also if possible, without waiting for any exits from fund 1. So, and some of them have managed to do it. And somebody talked about exiting the country itself, right? So, so that's the other view. So any views that private equity investors did private equity in India? Show of hands, right? Right. Another suspect, entrepreneurs. Entrepreneurs are to blame. We heard a few, diversion stories. The idea here is, entrepreneurs are kind of modern day Robin Hoods. They want private equity for one reason, and they want private equity to flow freely in India as long as it is to their pockets, right? And their line to the private equity investor is the old, Hero Honda line. Kind of, I have a beautiful tank, you fill it, I will shut it, and then you can forget it, right? So that's the entrepreneur view. So any show of hands, entrepreneurs kill private equity in India, right? This is the optimistic view, right? So the victim is still alive, and some of the speakers you're going to follow me are going to kind of make this case, and I don't have the data to support it, but I'm very happy to listen to the optimistic view, because at the end of the day, the future of venture intelligence could depend on that. Thank you very much.
Thank you, Arun. Our next speaker is Dr. Mukund Rajan, Member Executive Council, Tata & Sons, who will speak to us about the potential lessons the Indian private equity entrepreneur ecosystem could draw from the Tata Group's joint venture with various MNCs, including from the amicable partings of ways. To introduce Dr. Rajan, Dr. Rajan is the Tata brand custodian and member group executive council of Tata Sons. He is also the spokesperson of the group and the chairman of Tata Council for Community Initiatives. Dr. Rajan joined Tata through the Tata Administrative Services in 1995. He was assigned to the office of the then chairman of Tata Sons, Ratan Tata, in 1996, where he served for 12 years. In January 2008, Dr. Rajan was appointed as the managing director of Tata Teleservices. He then moved to Tata Capital in 2010 as the head private equity advisory and managing partner of the advisory team of the Tata Opportunities Fund, a private equity fund sponsored by the company. Dr. Rajan graduated from the IIT Delhi in 1989. He received a Rhodes Scholarship to study at Oxford University, where he did his post-graduation and doctorate in international relations. Can I please welcome Dr. Rajan to the podium?
Thank you very much. I think as Arun was pointing out just now, we are currently in an environment where exits, new investments, and fundraising are all presenting their own challenges in India. Clearly, the private equity industry in India is at a little bit of a significant cusp, with both investors and investee companies seemingly somewhat unhappy with the outcomes that they are seeing. I can empathize with many of these issues. Till last year, I was part of this industry as the managing partner of the Tata Opportunities Fund. Today, I thought in the environment that we are currently seeing, it might be worthwhile to reflect a little bit on the experience of the Tata Group on the subject of partnership. Our group has had the opportunity to work with a large number of partners, both from the private equity industry and through joint venture partnerships. On the private equity side, and many of you may know this, we have had investments and partnerships with a number of private equity funds. Cases in point include companies like Tata Sky, Tata Teleservices Limited, where we had investments from Temasek. We have seen exits to private equity. In fact, I think the first major acquisition by ICICI Venture was of the Tata stake in Tata Infomedia, as it used to be then called. And of course, our group runs private equity funds. Principal amongst these are the Tata Opportunities Fund, which is a $600 million fund, and the Tata Capital Growth Fund. Some analysts have even described the Tata Group holding company, Tata Sons, as a private equity player. The only difference being the hold period of Tata Sons is very, very, very long. I, however, do have my differences with this description of Tata Sons. In terms of joint ventures, over the last 20 years alone, we have undertaken over 100 joint venture partnerships. We've also had a significant number of exits. Since 2000, in the last 14 years, we've entered into 60 partnerships and had 20 exits. Our partnerships have been across the spectrum with corporate India. I'm thinking of companies like L&T, with government through public-private partnerships. I'm thinking, for instance, of our partnership with the central government in VSNL, Videsh Sanchar Nigam Limited, which is now called Tata Communications. And of course, with a number of globally respected names. And here one thinks about names like Mercedes-Benz, IBM, AT&T, Lucent Technologies, Honeywell. All of these firms were brought into India through joint venture partnerships with the Tata Group. I should stress that almost without exception, these partnerships have all been successes from the perspective of establishing long-term, viable businesses. Even where the joint venture partnerships themselves have ended, the parting has typically tended to be amicable. Now, basis this experience of partnerships, if there is one key message I thought I would transmit today, it would be this, that it is very important for private equity investors to have a long-term perspective about successfully managing businesses, even if their investment hold period is just going to be a few years. This long-term perspective, I would argue, has been the one key factor in the success of the many partnerships that the Tatas have undertaken throughout their history. Indeed, our core purpose has been defined, including by our current group chairman, Cyrus Mistry, as being, and I quote, the creation of long-term value for all stakeholders. I think we all need to remember that the brand a private equity investor creates for a private equity fund, basis its investment capability and approach to partnership, is noted and recalled for a very long time. It is therefore in the private equity investor's interest to communicate this long-term orientation if it wishes to attract high-quality investee companies to partner with it. So if you are a private equity fund today and you don't wish to be a one-fund wonder, and you have aspirations to emulate the likes of some of the gentlemen on the screen, KKR founded in the mid-1970s, Clayton, Dubilier and Rice, 78, Blackstone, 85, you will understand the value of creating a brand over the long term. Now, in the case of the Tatas, we have been building our brand for a little longer, for at least the last 140 years. And I do believe our long-term orientation has been paying off. Last week, some of you may have seen the news in the media about the latest brand finance report, which is a third-party report done out of Europe, where they have valued the Tata brand at a little over $21 billion. It is the only Indian brand in the top 35 in the globe. So let me now spend the next few minutes really outlining some of the key learnings from the many successful partnerships we have had in the Tata Group. Now, a lot of this is, as we used to say in IIT, Gyan, but I can assure you it is stemming from our personal experience. And towards the end, I would like to round off with some anecdotal commentary on a joint venture that I'm personally involved with currently, which brings to bear all of these learnings. And that joint venture is the partnership with Singapore Airlines, the Tata SIA joint venture. So the first key learning, I would say, is always identify partners based on a shared vision of the future. You must have shared values. There must be a cultural fit and good chemistry with the promoter. I think this automatically engenders teamwork within the workforce. We've seen this repeatedly, and you see the quote here from Howard Schultz on the Tata partnership on Starbucks. After many years of looking for an entry into India, Starbucks finally chose the Tata Group, and the key determinant for that was the sense of a shared value, a shared vision of the future, which Howard Schultz shared with our then chairman, Mr. Ratan Tata. Next, you must develop a shared business perspective for the long term. Typically in our joint ventures, we would have a very long-term view of where the market is headed and where the business can head. So you need to have a plan for at least the next 10 years. And then you build in some significant clarity on what you're going to do for the next 3 to 5 years. And then you have an incredibly granular plan for what happens in the first 100 days. It's not dissimilar to the way you would invest as a private equity fund. Once your plan is signed off by the shareholders, then you need to let the company run as a board-managed company, with the management being responsive to the board and not to the individual investors. So in the case of private equity, the management should not be answerable or separately meeting with the private equity investor. Ideally, all of you should be aligned on the board, and the management knows that it has only one place where the buck stops, where it is answerable, and that is the board of the company. Where trust exists between the partners, this also permits the company to then move at speed rather than trying to separately get all the partners or shareholders aligned. You need to get the best out of each partner. Now, in the case of private equity funds, and this is a view I held when I was managing the Opportunities Fund, I think there is great value to be had in identifying, for instance, an operating partner who has domain knowledge and placing that person as one of your representatives on the board of the investee company. I think the last thing an entrepreneur or a promoter wants is a kid who's recently been recruited, no domain knowledge. I think that's the easiest way to get the backs up of some of our promoters. Limit uncertainty. Any new venture is going to have a great deal of uncertainty. Getting approvals, getting permissions, deciding on the money has to be spent, getting regulatory approvals, all of that can be tension-filled, and your early few months can be extremely nervous times for the management. But what you can do is create the best environment possible to support the management in that period of time. Identify clear milestones that everyone agrees are potentially capable of achievement, and foster a feel-good environment. One of the ways to keep morale high is constantly celebrate, especially in the early days, frequently, all the wins that your partnership register. Try and demonstrate humaneness and kindness. Now, this is a very Tata thing. One of our former chairmen, J.R.D. Tata, who led the group for 53 years, and in whose time we saw some of our biggest growth, used to say, to be a leader, you've got to lead human beings with affection. And I think this is so important when you're getting into a new relationship with a partner or an entrepreneur, promoter, who the first time is receiving private equity investment. I think they need to feel that you have this sense of commitment, of being friendly and understanding how you can help them to take the business forward. And finally, and especially in the case of listed companies, I think you've got to work very hard to manage public perceptions and the expectations of external stakeholders through transparent communication. In fact, the one thing that we keep insisting is you must communicate. I think it's inadequate communication which often sows the seeds of trouble between partners. So the more you communicate, the better it is for the partnership. So really these are the key messages from the way in which we've seen our partnerships work out. And it all really starts with the very first point, which is have a shared vision, a shared view of the future, and then all else falls into place. If you don't have that at the beginning, then often things can go completely wrong. Now, as I mentioned to you, I have had the privilege of serving as a director on our new joint venture with Singapore Airlines. And many of the lessons from the Tata approach to partnerships have really been very vividly illustrated to me in this particular joint venture. So let me walk you through a little bit of the history of this joint venture. While we signed the joint venture partnership last year, 2013, and it is likely to see fulfillment this year in terms of an airline that will be launched hopefully in the second half of 2014. The fact is, we first discussed a partnership with SIA 20 years back in the early 1990s. Now, this followed discussions between the Indian government and the Singapore government, who were keen to create a new economic partnership between the two countries. And the Singapore government offered that Singapore Airlines would be willing to come into India to launch a world-class airline, and they needed an Indian partner. The Indian government recommended that Tata's could be that partner, and when we were approached, we agreed. Initially, this was supposed to be a 60-40 joint venture, 60% with Singapore Airlines and 40 with the Tatas. After some discussion within the then Congress administration of Narasimha Rao, it was felt that 50-50 for an equal partnership between two countries would be seen better. So it became a 50-50 partnership. But before too long, there was further discussion and debate in the Civil Aviation Ministry, and the advice that came back to us was, it's a domestic airline. It's the first time we're letting a foreign airline come in a partnership. It would be better if it is majority Indian. So can it be a 60-40 partnership, 60 with the Tatas and 40 with SIA? Through all of this, SIA held firm that they would be interested and willing to partner with Tatas. And so we finally agreed on a 60-40, and then the Congress government fell. The mid-1990s, as you all know, was a period of many coalitions. I think all of us have our eyes on this year's general elections, and we hope we don't go through that same experience again. So come the coalition governments, and I think for reasons that all of you are well aware of, that have been widely reported in the media, a new policy was introduced which said, forget about foreign investment in Indian airlines by foreign airlines. India will be a country that will decree that there will be no foreign airline investment in the Indian domestic airline. Now, you would have thought that would be the end of the road with SIA. But they came to us and said, we are fully in support of a world-class project for the Indian market. So if you wish, we're willing to back you with a technical agreement. We can have a technical services partnership, no equity, just backstopping you on the technical requirements and the training. So we agreed, and we went back to the government. And as had been happening for several years by then, our files didn't move. And we waited. And then, of course, the coalition governments came and went, and finally you came back towards the late 1990s with the national government led by the BJP. The BJP this time around said, why do you want to come into India with a new airline? There is an airline called Air India, which, by the way, Tata's used to run till it was nationalized. So we are thinking of privatizing Air India all over again. So would the Tatas be interested in bidding? We said, it's worth a look. So we went back to SIA and said, you want to evaluate management control of Air India with us? You providing the technical support and we investing the equity. And SIA said yes. So we looked at the airline, and it became clear it was worth investing in then. I don't know about the situation today with the amount of debt that they have, but at that time it was still quite interesting. So we spent probably a year and a half looking at the airline, participating in the bid process. It went through several rounds. The last round, I remember, it was the Hindujas and the Tata Group. The Hindujas were eliminated, and finally that left only Tatas as a successful bidder for Air India. And for the same reasons that had worked earlier, our files didn't seem to move. And finally, in 2001, I think close to 7 years after we'd first decided we would enter the Indian civil aviation market, we decided to throw in the towel. We said, enough is enough. We waited long enough. We can't provide more management resources in the hope that at some point the government will see the value of creating a world-class project for the Indian civil aviation market. I remember Mr. Tata then writing a letter to the Indian government, to the Prime Minister, saying we're pulling out. We decided to disengage. In some ways, maybe it was poetic justice that a little after our decision to disengage, you had the unfortunate tragedy of 9/11, the attack on the World Trade Center, and the entire global civil aviation industry tanked. So I wonder what would have happened if we had actually succeeded in our bid for Air India and then this had happened. So in any case, we disengaged, and then for the next 12 years, we were out of civil aviation in India. Last year, when the Indian government, in its wisdom, now announced that it had seen fit to revise this policy, and investment by foreign airlines in Indian domestic airlines, they thought is actually kosher, and they would permit it to the extent of 49%. You had Singapore Airlines receiving approaches from most of the Indian domestic airlines for a partnership. And the beauty of it is they came back to Tata's and they said, look, this rule is going to change. If the industry opens up, at one time we talked about an entry together, would you be interested? So we heard them out. We went through several iterations of looking at a business plan. As I said, looking at the long term, looking at the medium term, looking at what would happen in the short term. And India, by the way, has this very interesting rule of 5 and 20, 5 years in service and 20 aircraft before you can fly overseas. So we evaluated all of that, and we finally decided that we had a good business case, and more importantly, a long-term prospect for the industry in India that made sense for us to partner with Singapore Airlines. So we said yes. And finally, we did sign the joint venture agreement. In rapid time, our proposal went through the FIPB, and now it is awaiting approval from the DGC and the Ministry of Civil Aviation. The moral of the story is, and I'm going to end with this, if you care about your brand enough to do the right things, including, and this is relevant to many of the friends from the private equity industry here, including walking away from deals when appropriate, I think ultimately your brand equity gets established and the best deals will come seeking you. That's what happened with us in the case of Singapore Airlines. And it may take time. Sometimes it takes 20 years, but ultimately the right thing happens. That's what I wanted to share with all of you today. You've been a very patient audience. Thank you very much.
Japanese, and in the case of, I remember Tata Toyo radiator company recently, where it's an existing Japanese joint venture of the Tata Group. A Chinese company has come into the venture as well, right? So some contrast, if at all there are culturally, otherwise in engaging with Western, Japanese, something that you can share?
I'm not sure at this point I would be able to give a lot of detail on that aspect. We've had very successful partnership with both. Culturally, I think the kinds of discussions you have, the number of iterations you go through, and the attention to detail which parties from the United States or Europe pay as compared to the way the Japanese approach it, I think there are significant differences and nuances. But ultimately, again, if you go back to that first point, that when you have a shared vision of where you think a particular product line or service offering can be taken in this case, the Indian market, and you have a common set of values, then everything else tends to fall into place, regardless of the approach. We have had companies where people have tended to have, our partners have tended to have sometimes a little bit more of a cowboy style. There have been entities that have been a little bit more conservative, very dedicated to how each dollar is spent, particularly in the early days. Our current experience with the Singaporeans, again, extremely cost conscious, and so it's a mixed bag. I think it takes all kinds. But what we found is if you start with a common premise on where you think the market is headed, and you have a common understanding of the way you want to manage the company, common values, the rest of it does tend to fall into place. So I don't think we've seen huge differences apart from some of these cultural nuances, the way people approach discussions and the first few board meetings. But then you fall into a pattern And after a period of time, I find that there's very little difference between the way one board functions and another board functions. In telecoms, I was very familiar with the way in which Docomo, for instance, used to work with our team. And they had the same kinds of issues that today I'm seeing, let's say, with Singapore Airlines, or that we saw with some of our American partners, be it IBM or Honeywell or German Mercedes-Benz. So over a period of time, once there is comfort on both sides and they understand, the level of detail you want to get into at the board and so on, there aren't that many differences at the end of the day.
One more question, if there is any.
Thank you for giving me the opportunity. I just want to know that, as we have discussed earlier, the PE funds normally look for 3 to 5 years period for exiting. What is the case with the Tatas? In Tata's case, when you take fundings, the same case is with you also, or you have a different, sort of?
So our private equity funds operate on the same premise. So the Tata Opportunities Fund is a 10-year fund with potentially 2 annual extensions. So it's a 10 to 12-year fund. So we'd be typically looking at a 5 to 7-year hold period. The Tata Capital Growth Fund is a 7-year fund, so they might be looking at a shorter hold period. But when we look at joint ventures, the hope is that these would last, like many Tata companies, for 100 years.
Yeah, JV is a different concept, but
Yeah.
I'm talking about the PE funds.
So the PE funds are exactly like,
that normally.
yeah, that's right.
Thank you very much, Mukund. I know you have to head out, and thank you very much again for the
Thank
talk
you.
and sharing us.
Thank you, I appreciate it.
Thank you, Dr. Rajan. Now we'll start our next panel session. I now request Mr. Shamil Chotai, founder director of Tridha Advisors, who will be moderating the rest of the growth capital session, to come over to the stage with his co-panelists. I'll take a minute to introduce everybody. Mr. Shamil Chotai has 13 years of experience in venture capital, private equity, investment banking, and corporate banking with companies like Nomura, Meghraj, Gujarat Venture Finance Limited, and ICICI Bank. He recently started his boutique investment bank, Tridha Advisors. Shamil holds a post-graduation diploma in management from Nirma Institute of Management, Ahmedabad. The next member would be Arun Uday. Arun joined Headland, subsidiary of Headland Capital Partners, in 2007 and is a member of the venture capital investment team. Prior to joining Headland, he worked with Ernst & Young in Mumbai and then in Patni Computer Systems in Mumbai as part of the M&A team and Cognizant Technology Solutions in Pune. He holds an MBA in Indian School of Business, a Master of Engineering from the Indian Institute of Science in Bangalore, and a Bachelor of Science from Bangalore University. Can I have him on stage, please? Right. Moving on, the next person would be Avinash Luthria, Gaja Capital. Avinash has over 13 years of experience in private equity, management consulting, and project management. Prior to joining Gaja, Avinash worked for Tata Strategic Management Group, Mindtree, Wipro Technology, and Emphasis BPO. He holds an MBA in IIM Bangalore and is a graduate in Computer Science and Engineering from RVCE Bangalore. Can I have him on stage, please? Dimple Sanghi, Director Investments, Omidyar Network India Advisors. Dimple leads investments in financial inclusion focused on India and Southeast Asia for Omidyar Network India Advisors. Dimple joined Omidyar in 2012, bringing 21 years of in-depth knowledge in financial services, including more than 11 years of private equity in India. More recently, she served as a managing director at Everstone Investments Advisors, a leading private equity and real estate investment firm. Dimple earned both her law degrees and Bachelor in Commerce from Mumbai University. She is also a fellow member of the Indian Institute of Chartered Accountant. Ms. Seema Jinghan, partner, LexCounsel Law Offices. Ms. Seema has substantial expertise in representing investors, developers, venture capital, and private equity funds, international corporations, sponsors, lenders, and other strategic investors involved in the embellishment, development, and, of course, finance of infrastructure, telecom, education, information technology, and satellite projects in India. Seema has been designated as a leading lawyer in the area of IT, telecommunication, and media by Asia Law and regularly contributes to journals and publications. Now I invite Mr. Shamil to come and take over.
Thanks a lot. Morning, everyone. We have basically two very tough jobs. The first is to follow the panel, excellent panel which was there in the morning. And the second is basically to defend growth private equity, low touch growth private equity. A lot of stigmas associated with low touch, and that people just take minority stakes, try to take money. They're not really adding any value. We had some comments from entrepreneurs that they actually not only add any value, they actually take away value, right? So we will try to defend that a bit, and we'll also see some other perspectives. I think some of the perspectives which have not come are the legal perspectives or the perspective from the LP. We'll try to see, or from the professional. We'll try to see if we can bring some of those perspectives to this panel. Brief introduction, it is not Tridha, it is Tridha. Tridha is Tridha, which is like three tools, head, heart, and the hand. So we say strategy, relationships, and execution. So that is the form that we are trying to set. Growth capital in India, actually many of you missed Arun's presentation just before Mukund's presentation. He essentially summarized who are the culprits who killed growth capital. So his thesis was that growth capital in India is dead, and it has been killed by financial markets, intermediaries, or investors themselves, promoters. So he basically blamed a lot of them. I will try to defend growth capital in India, the low touch one. And I will say that it's not, the king is not dead, it is long live the king. Yeah, I will just first react to what he said. He's blamed financial crisis. I would say financial crisis has resulted in quantitative easing, which has actually ensured a lot of money flowing into the global markets. More so in the developed markets at the moment, but a significant part of it in the emerging markets as well. We already seen public markets react, and they are at new highs. The government is trying. I will not say that the government has not done anything. In the last 1.5 to 2 years, Mr. Chidambaram has taken a lot of steps to attract investments. They have been making efforts specifically for private equity and angel funds. They announced regulations like the AIF regulations, which is a bit of, they want to expand the market. It allows hedge funds to come in. It allows various sectoral funds to come in. For the future, it allows people, the governments to allow taxation benefits for category 1 funds, which are beneficial to the economy, and in fact tax disincentives for category 3 funds, which are hedge funds, whatever the government wants, right? So it sets a platform. RBI has also allowed put call option, but I would add a star to that because it is allowed, but it is the valuation is as per fair value or chartered accountant, which is not what people typically want. But there are some efforts which are being made to revive this or to sustain this industry. Corporate India, there is no use putting the blame on corporate India. It is facing the same environment essentially as private equity. Basically, we are in the business of creating businesses. Corporate India does the same. Corporate India increasingly delivers value to shareholders. There are a lot of perspectives. We see many people now focus on the shareholders vis-a-vis the promoters. Professionally, better governance. Yeah. Intermediaries, a lot of people blame intermediaries for this, but intermediaries, which now I am, are basically matchmaking, trying to create value by managing expectations of the promoter and giving the private equity guy what he wants, right? So the intermediary is actually trying to marry them. And some of the, we may take some of the blame by, creating complicated structures so that they actually marry. rather than a simple, straight equity and round. But this is what the market wants, and this is what we have to deliver. And unlike funds which might stop investing, or promoters which may slow down the business, our business is to do deals. So then we need to create those deals, right? The investor, again, I would say the investors have matured. A lot of professionals. I mean, there are a lot of experience we see now, tremendous experience of all kinds which the investor has. They are specializing. They are moving to various asset classes in terms of specialization. If you see most funds now, they are organized. They have people who look at certain sectors. So these guys then basically know something about the sectors. They are not fresh IM guys, Harvard guys. You will see increasingly that there are people who can add value theoretically to the industry companies. This will play out. Hopefully, it is already playing out. Yeah. And entrepreneurs obviously cannot be blamed. Their motto is stay hungry, stay alive. So they have to stay hungry. They have to always need capital, and they are in the growth business. They actually want to grow. You cannot say that, because, there are very few people who really want to siphon of money out of the private equity industry. This industry is mostly for people who want to grow, and that has been supported by the earlier panel, where they say about 90% is this, right? I'll try to say what are the few positives now for the industry. Yeah. I think I mentioned some of this. The businesses are maturing. There are better corporate governance standards. Private equity is matured. I mentioned this. Demand supply is balancing. 2007 times and all were pretty crazy. A lot of supply, a lot of deals. There are a lot of cartoons there where any guy with an idea could get checks. So all of that is better now. There have been recent exits. Although the exit trend, which it shows, has been slowing down, what we need to realize is that there have been consistent exits since 2007. And these are all $10 billion per year exits, right? So there are exits which are happening. It may be, so the peak may have been $15, $16 billion of exit, but it has been, even if it is 12 or 13 today, this is still a significant amount. So there are exits which have happened. There are marquee exits, there are success stories. We speak to a lot of promoters. If you speak to promoters, they feel that, this is a great market. There are a lot of people who have made exits. The promoters have made money. The private equity has made money. So there is a lot of optimism there because of exits. It also results in better visibility for the next funds. Now, earlier, a couple of years back, anyone who was trying to raise a fund said that now we are dropping it. A lot of people, I think 100 people, 150 people in the industry were raising funds. None of those funds have been raised. But now you see more visibility that yes, second round, third round is possible because of the exits, because of the general conditions. So it seems like there is a bit of bottoming out even from that aspect. There is emergence of angels and action in the early stage deals, which is ultimately a pipeline for the growth PE. This sector is doing exceedingly well. I think half the ads that you see are for .coms or growth PEs. These are all supported by early stage venture capital funds. As I said, private equity funds now focus increasingly on specific sectors, which is also a step in the right direction, although they are low touch still, but they understand the sector. I mentioned these, and then if Indian economy looks better, then it is always better for the equity because capital is required for growth. So growth capital is very much alive and active. It is now with better alignment. It is not too low touch. People understand where to add value, where to just step back. I think there is a consolidation. There is a flight to quality amongst the investors. There is better focus. There are operating partners now, which even if they have if you have taken a minority stake, there are operating partners which will add value to your business. There are fairer valuations because of the demand-supply matching, better risk-reward structures, better alignment in general. There is more emphasis on monitoring and exits. We saw in the morning, people think of monitoring exits when they invest. They know who is going to monitor this, what is the exit, what are the targets. That is from the very beginning. So therefore, it is not death, only resurrection. On the counter side, what I would also like to mention, it's not covered here, is that, what is the alternative? Alternative is high touch investing, right? So, I know I'm going against the trend, but it's not necessarily a good thing. There are certain issues involved with that. What it requires is, first of all, you have to avoid being a conglomerate, right? There are high touch. Blackstones and KKRs, these are the big funds in the world. They are almost like the Tata Group, right? In a way, they are big conglomerates. They have professionals which are running. And this is the thing which happens, that you need capabilities which are like the promoter. So why would you want to do that? This is a different asset class which supports growth. And I don't think it's necessarily a bad thing. In fact, this played out a lot while Obama versus Romney election, where Romney represented Bain Capital, and there was a lot of bad press which had also come out against these things. Also in high touch PE, you need professionals. What these funds essentially do is they hire professionals. The Indian market has not yet seen that kind of things where, I take over a company, I hire the professionals who will run it for 3-4 years, I take my exit and go out. What will have to happen to the professional after that, If he's also in it for the game, okay, I will go to the next company and then we'll leave this, it's not necessarily good, right? We need emergence of professionals which want to run this industry or which want to do this high-touch thing. Without that, low growth is the better way to go, in my opinion. There is a bond market perspective. A lot of high-touch works because bond markets are mature. You take over companies with equity, you load them up with debt, you improve efficiencies, you take some money out, you return shareholders' money. There is pressure on the management. But bond market in India is not really developed. You cannot do any of those things here. Seriously, if till the bond market develops, I don't think something like this is possible. In fact, some of the woes of the infrastructure sector are because of the issues with the bond market. IB is trying to do some of those things. Finally, let me take some perspective of the employee and the promoter. Promoter has built something, he would want to grow it himself with support from capital. And from the employee, he wants security, he wants to stay there in a company which he has helped grow. So I maintain that, low growth, it's like Maruti, this market is like, it is 83% of the market, it might lose market share, it might go down to 60%, but Maruti, it will rule India for some time, and I think it's a good thing for us. However, that said, a few tweaks can always help, and for that I would ask Seema here to, maybe suggest a few tweaks which might help the low growth period. Yeah? Seema, please.
So I'm the lawyer. I heard some very flattering things about the lawyer community in the previous panel. I'm not going to defend myself because some of it is true. Just to give me a perspective, how many of you are here representing the entrepreneurs? Can you just raise your hand just to give me a feel? Oh, so that's a fair bit. So the presentation that I have prepared is actually to help the first-time entrepreneurs to understand the dynamics of seeking investment. I heard somebody from the audience just before in the previous panel that how do I know I'm doing the right thing? How do I know I'm walking the right path? So the presentation is more focused because usually the P funds have a team of lawyers and they're more evolved in terms of their understanding. So I'm going to be discussing issues related to what is the way forward? Is the growth capital, which is a minority stake investment process, is it a reality right now? Is it surviving? And what are the tweaks that we need to do right now to take it forward? So the fundamental reality is that low stake growth capital is a reality. It is there to stay. I don't see that going away. For instance, in the last 7 years, the 25%, less than 25% has been the underlying theme for investment. The reality is, as long as the investor gets the strategic say, the say in the strategic business decisions of the entrepreneur, they are preferring and they prefer the less than 25% equity stake. This is fundamentally because of the entrepreneur's mindset that we have in India, because it's like a baby for the entrepreneur. It's a passion. It's the years and years of toil and hard work of the entrepreneur, and they do not see themselves parting away with that. And that's the reason, in the Indian context, it is going to be a majority stake with the entrepreneur. But there are some tweaks that we need to do, and there are certain learnings that we have to learn, and this coming from my own experience dealing in private equity. So the first issue that needs to be looked from an investor point of view, the things that they need to look at is when they're coming for investment, they have the understanding that their capital is very critical. It's very, very important for the expansion and the growth of the entrepreneur. Now that sets the tone for the further discussion. And the tone is that I know that you need my capital, and therefore I have the attitude to push through things which possibly a majority stakeholder should have, but since I am the one trusting you and putting my valuable capital, you have to give it to me. So what are the things that they usually negotiate at the point of investment, which typically belongs to a majority stake relationship, but are negotiated by minority stake investors? So it starts with the board nomination. The first thing that the investors need to realize is that if they're putting less than 25% stake equity, they cannot be seeking 2 or 3 board members in a 5 board member board. The reason is the proportion to which you are investing is critical. The large part of the decision making of the Indian system is through the board management, and seeking disproportionate rights in the board seat not only creates distrust, also creates a sense of discomfort amongst the entrepreneurs, and that needs to start changing going forward. The other thing that they require is the mandatory quorum requirement. That's an understandable stake. Now, what is a mandatory quorum requirement? It basically means that any decision that the board is going to take at the point of, at the board meetings or a shareholder meeting, the representative of the investor has to be present. That's understandable. Well, how it becomes a problem is when all the subsequent adjournments, adjournments of the board meeting or the shareholders meetings continue to require a mandatory presence of the investor. And there could be a point of time where the investor is not cooperating, he's refusing to come to the board meetings or the shareholders meeting, and leading to non-compliances at the investee company's level. But the presence is required. So probably as an investor, as an entrepreneur, when we are giving the equity away, we need to draw a line that yes, at the first board meeting, we can give you the quorum requirement, but subsequent, second, third, if you don't come, too bad, we will go ahead with the meeting. Then there's another thing which the investors usually negotiate is a reserve matter. It's a long list of reserve matters. Basically means that what are the decisions that the entrepreneurs cannot take without the consent or the approval of the investor. Now, it is again a very important, because I represent both the buy side and the sell side, it is an interesting and an important tool in the hand of the investor, and it's definitely required. But what is required is that you should get a understanding and a say in the critical decision making of the company. It could be related to capital investment, it could be related to amalgamation or further investments or joint venture. But when this list continues to go longer and impedes into the day-to-day operations of the operating company or the investee company, then it becomes a problem. How much lease that you can take, how much can you go and buy a particular trademark, can you do a copyright arrangement? If every decision requires an investor consent, that becomes a problem. So when we are negotiating minority stake investment, and this is specific to all minority stake control issues, because if you are giving away the control, then these are not the relevant issues. In a minority stake control issues, reserve matter list needs to be trim, slim, and workable. So that the investor does not start going into the operational aspect. The other issue is the dynamics with what the investor wants to give to the investee company and what the entrepreneur is looking. Entrepreneur is typically looking at, from the investor, is related to international and domestic expansion plans or strategy issues. But what the investor see himself and is beginning to see himself is putting himself in the role of the vision and the strategy, into the corporate governance issues, into the issues related to going forward into the operational. Why is that decision taken in a particular way? Why are these particular contracts not done? So when you start getting into the operations, the ship starts to rock, because the operations are best left to the entrepreneurs. Your agreements that you are going to be signing needs to be very clear of where you're drawing the line, and do you need to walk away from the investment at that stage? Reporting requirement is another issue which becomes a pain point. Well, it's fine that you need to have a monthly reporting and an audit report, a quarterly report, an annual report. But do you need to give a report every week? Come on, that's too much. So when the investor starts asking reports a week, that means that the relationship is where the entrepreneur is not being trusted, the promoter is not being trusted, his decision makings require monitoring, and probably that's something that you need to be very careful while drafting a joint venture or shareholders agreement or an investment agreement. The other issues that the investors usually seek in these kind of deals are anti-dilution, ratchet, and preemptive rights. Now, what are these rights? Basically, just to concise this very, very briefly, is when you're seeking, as an investee company, if you're seeking any further investment from any other third party, you need to give a notice to the investor. He needs to say yes to it. When it comes to the preemptive right, that's understandable, which means the investor will have a right to invest, co-invest with the second rung of investment. But when they have an anti-dilution right, which has a veto, which basically means you cannot bring additional investment into the company without the investor fund, you're in trouble. So stay away from rights which sort of take away your, as you may call, sovereignty or your independence or your decision making from investing or seeking further growth capital into the company. Lock-in is another problem area. Now, it is from the investor point of view, if he's coming into a promoter company, the promoters needs to be there, definitely. But is there any limit to the lock-in? It should be in eternity? Absolutely not. I can understand 3 to 4 to 5 years of lock-in, but if you're buying 20% stake into my company, what business is there to say that you will never invest for the rest of the cycle of the investment till the investor exits? Because as an 80% owner, you should have the right to dilute yourself 5, 10 more % to leverage the equity that you've created, as long as you're not becoming minority stakeholder. So these are the things, little things that you need to be a little careful when you're seeking investment, that are you in your zest to get the capital, giving away long-term operational and long-term exit options for yourself also as a promoter. ROFR right and ROFR rights, I'm going to park this here because I'm going to discuss this in a little more detail when I discuss the exit routes. But basically, what these rights are, when the investor is, when the promoter is wanting to exit, before the investor has exited, then the promoter should be giving a right of first refusal of buying out promoter's equity to the investor. Well, that's fine, that's fair. Now, interesting is both parties should get this right, which basically means the promoter should also have this right when the investor is going out. The promoter should also have a right of first refusal to buy the equity of the investor. That's important. Second would be, do they have tag-along and drag-along right? I will discuss this in the next slide a little more detail. This is slightly a draconian kind of a clause which is usually there in most of the PE-invested companies, and I'll discuss it in a bit. So, complicated exit options, and we have heard some views in the previous panel that the exit options do not work, but that's a reality. We spend, as lawyers, as accountants, we spend hours and hours discussing the exit rights. Do they really work? Absolutely not. They do not work in reality. In my 20 years of experience as a commercial lawyer, I haven't seen a single case where the exit has happened based on the rights which have been negotiated. It always based on the trust, the relationship, and the willingness of the promoter to give the exit. But that doesn't mean that you should not be reading what you're signing. Somebody in the previous panel had said, just sign it. I wouldn't advise that, because you should be a little aware of what you're signing. For example, if you've signed a buyback. Buyback basically means that the company will have an obligation to buy the shares back from the investor at a particular given of time. The second option is a put option. Put option is slightly more dangerous. The promoter who has brought in the equity, he didn't have the money in the first place, has now committed and obligated to buy back the shares back from the promoter at a X ROI rate. Now, is that going to happen? Because promoter in the first place does not have that kind of wherewithal to buy it back. But typically, all PE-invested funds do ask for buyback options, and they are predetermined. The prices are predetermined, that you will give me 5 multiple, 6 multiple, and this is a mandatory buyback option, which, if not complied with, becomes a case of non-compliance by the promoters. Obviously, promoters are going to be looking mean on the other side, because they will never be able to comply with the exit option. So read your agreements very, very carefully, and this is also a tweaking which is required from an investor point of view. That do we need these kind of rights, which is actually requiring? I can understand strategic sale, I can understand third-party sale, an IPO, that's a good option, though it's a little depressed right now. But buyback and possibly put options are worthless rights negotiated for the mental satisfaction. Doesn't happen really. Now, what is a drag-along right? Now, drag-along rights is a very, very important right that we need to be a little careful. As an investor, I have invested 20% stake in your company. You're the 80% holder. I need an exit after 5 years. Well, you have failed to do an IPO. Too bad. You haven't bought my shares back. Well, I will get a third-party investor. I will make you drag with you. So you will be dragged along with me. How fair is that? Is anybody thinking here it's fair? I'm a 20% holder and I'll drag the entire company in a strategic sale because the third-party investor who's coming, he wants 80%, so you have to sell your 80% too. Please stay away from such clauses. What you can negotiate is, if you are the 20% investor, then the proportionate drag can happen, which basically means if you're selling your 20 as a promoter, I have to give you an exit, and I haven't done that, and I have failed into that. Probably I should give you a 20% proportionate drag out, a sell of my equity. So these were the issues that you should be looking from an investor, from an entrepreneur point of view, that these are the things that you should be a little wary when you are seeking third-party investment. For the low touch growth capital to continue, it also means there is a lot of faith, a lot of trust that the investor is putting into an entrepreneur who's probably not post-profit. He's still there, he's still needing your capital desperately, not getting the bank loan. Therefore, there are certain tweaks that we need to do from an investor, from a satisfaction also, which are the roles that the entrepreneur has to play. First of all, the mindset of the entrepreneur that investor money is free ticket money and needs to change. This is not a free money. There is an ROI return. This is the business model of the investor, and we need to be a little cognizant of where we're using the money to. Now, the compliances. The biggest problem which happens in a relationship, which rocks the boat when it comes to the investor-investee relationship, is non-compliances. Whether it is the compliances related to milestone compliances, performance-related issues, reporting issues. Once you have negotiated your deal, once you have negotiated the obligations that you're assuming, it is required to comply with. So in a particular deal, if you're representing the buy side and there are two potential investee companies, and one of the investee company promoter is going through every word, every clause of the agreement, and the other investee company promoter is just ready to sign everything, our always advice is be wary of the second one, because he's signing on everything is there on the paper because he knows in his mind that he's not going to comply with it. Be wary of such investors who are not reading through their documents, because in back of their mind they know that the compliances will deal with it later. So compliances is the cornerstone or the fundamental of any relationship, and specifically where the money is being invested based on your trust. Okay, so I'll just wrap it up quickly, which is again from the investor point of view, which is unapproved business plans. Do not divert money to the plans which are not been approved at the business level. And strategic investment decision-making has to be between the investor and the investee. Exit options. Again, so once you've negotiated for the exit options, they are for keeps. They needs to be complied with. So be very careful of what you're agreeing to, and once you've agreed to it, it needs to be adhered to. So at the end of the day, basically the relationship is not governed by what the lawyer agreement is all about. It is governed by the relationship that you've created in the last 3 to 4 years. It is based on harmony, trust, creative flow from both sides, cooperation, and building the business and expanding the business. If that is maintained, then the relationship is going to go forward. And based on these issues, basically the low touch growth capital is going to survive as long as these fundamentals are in place. Thank you very much.
Right. Well, I think that was a very enlightening presentation. I just have a couple of points to make, largely from the practical side of it, is that I think most of the mistakes and the list that was already put up over here, we never put LP as a list. So I think the biggest mistakes have been made by the LPs, who actually funded so many funds, and we have so much capital chasing, very, very few deals, which is why valuation is an error, which is why expectations are set pretty high and time limits are pretty low. I'm an LP, and let me tell you that I am probably part of this whole problem. That said, one must be cognizant of the fact is that when we have really very tall orders and very limited time horizon to meet with, there will always be made mistakes. Let me clarify a little bit more with the analogy. I think most of us would have taken a cab at some point in time, long distance, sometimes share a cab, sometimes just by ourselves. And we assume that the driver has a license, the cab has a license, he has fuel, and the driver knows how to drive. And we sit in the car and we just go. Sometimes we may not be able to reach the destination. Sometimes we may be able to reach the destination. Sometimes we have problems halfway through, changing tires, telling the guy to go slow, telling the guy to go fast. This is exactly the relationship that an entrepreneur and an investor needs to have. Light touch, be a guide as to where the destination is, but please have faith in the entrepreneur that he will take you to that level. Just to give you a little bit background, I'm from Omidyar Networks. It has been founded by Pierre Omidyar, who is actually the founder of eBay. And the first premise that he had is that believe in people, that people are good. And that's how eBay was born, where people halfway across the world were trying to sell goods, services, which were already used. But always the premise was that I believe that whatever the person is telling me is going to be true. When I do ship my goods, I'm going to get my payments. We at Omidyar Network believe exactly the same. We have a balance sheet. We invest in both for-profit as well as not-for-profit, but we definitely believe that we are here in for the long run and helping the entrepreneur to take us to the next level and enjoy the ride.
Thank you. Avinash, you say a few words. Yeah.
Thanks. I've been an entrepreneur and I'm an investor now. I was a failed entrepreneur. So I've seen both sides of the table. This was back in 2001, 2, 3 when I was an entrepreneur. And at that point, we got a round of angel funding. This was a legal KPO. And it was tough times to raise money, and we didn't get a further round of funding. And the point I'm making is that many of you are early stage entrepreneurs right now, and growth capital is kind of far removed from your lives right now. Maybe at some point it's relevant, but it has a direct relevance for your investors in early stage investments, because growth capital funds provide an exit to those investors. And the dearth of early stage investment capital that you had in 2001, 2, 3 was because there was no one to buy those stakes from early stage investors. Luckily for India, now there's a material size growth capital industry which buys stakes from early stage investors. So growth capital is important in itself, and also, I mean, for its investors in growth capital, etc., but also as a means of exit for early stage investors. A couple of reasons why growth capital hasn't done so well. One is there has been, as everyone said, a demand-supply mismatch, essentially meaning too much of capital chasing too few good deals. What that did was drive up valuations at which investors invested, and hence returns have been poor for investors in growth capital. One part of the reason is just that demand-supply mismatch. A second part has been people question, is growth capital as a strategy itself correct? I think we should take a step back and realize that growth capital, low-touch growth capital, where essentially growth capital investors are minority investors, is a tweak that was designed for India in a sense. It's not unique to India, but it's a tweak that's already been designed for India, saying the entrepreneur is in the best place to run a company in India. It is very difficult to be an entrepreneur in India. Let the entrepreneur do it, let the investor fund him. So what we're talking of here is, do we need a tweak on the tweak? My take is we don't. Growth capital is the right model for India. I don't think the strategy has a problem. Often people feel that because returns have been poor for the last few vintages, maybe we should try control investments, maybe we should try early stage investments. There have been a few successes in early stage investments, but you've got to look at it from a portfolio point of view. And from a portfolio point of view, you have a few multi-baggers, but as a portfolio, you don't have sufficient data to say that early stage investments have done very well or better than growth capital. Anecdotally, it seems so, but there isn't enough data to say so. There is absolutely no data on buyouts or control investments in India, minuscule data. So really people doing it, it's right. People are saying, let me try this, but it's an untested strategy still. Finally, I think the point really is that strategy is fine. It's really the execution of the strategy, which is common in many businesses. There's no problem with e-commerce. It's in the execution of e-commerce. Similarly, in growth capital, it's not the strategy, but it's the execution of the strategy. I think we as investors in growth capital have to be far more diligent about the investments we make from a business due diligence, from a point of view of saying, is this a person we can partner with? We are finally trustees of somebody else's money. This is not money of our own. Just as when you put money into a mutual fund, you expect that a mutual fund manager does what is right for you. The same way, a growth capital investor is a trustee of somebody else's money. And he needs to be far more diligent than we have been as an industry in the past in making sure that he's rigorous about and diligent about making those investments in cases where he will get back his capital, avoid mistakes, because avoiding mistakes is probably the one easy way to kind of improve returns. I think finally, a little bit of empathy, I think, would be useful from both sides. We as investors see venture capital and private equity agreements every day, so we're used to it. And 95+% of private equity or VC agreements look the same. From an entrepreneur's point of view, it looks very jarring and draconian, but that's pretty much what 95% of agreements are. But we as investors have to empathize with the fact that the entrepreneur is not seeing it every day like we are. And it's kind of, we have to realize that it's jarring to him. Help him understand it and tell him, not just tell him sign, don't worry, just sign. But explain to him what each of these means, and also explain to him that we actually are serious about those points. They're not just paper points. They may not get implemented, but the intent from the investor side is they're serious about it. And I think from the entrepreneur side, it's important to understand that just like you trust your mutual fund manager to do what's right for you, somebody has put their trust in a growth capital investor's hands. So the reports that he asks, etc., is because he has to do his job as a trustee of somebody's money. And I think we have to just empathize with each other and be on the same side of the table in some ways.
Thanks, Avinash, for the great points. Arun, if you can say a few words.
Yeah. I was sitting there at the back listening to Arun Natarajan's opening remarks on who killed growth capital. And I was thinking to myself, this session a little bit reminds me of the News Hour debates with Arnab Goswami on Times Now. Because with that kind of an introduction, there is very little hope for the rest of the panel to really salvage the situation. When I see those debates, I can almost imagine what must be going through the spokesman's minds, which is that पता नहीं किस घड़ी में ये इस पार्टी का spokesman बन गया, पर अभी इधर बिठाया तो कुछ तो बोलना पड़ेगा. So somewhat similar is the situation here. It's a difficult situation out there. I don't think, and the data speaks for itself. Growth capital, as we have seen, has not done well. But I think if you were to ask the question whether there is a play for growth capital at all in India, I think you can break that down to two questions, which is whether there is growth going to be happening in India first, and whether that growth will require capital. I think pretty much the answer to both must be yes, right? I mean, I don't think anyone in this room will really doubt the fact that there will be growth happening in India. Maybe it may not happen at 8 to 10%, it may happen at 6% or 7%, whatever that is. But I think given the overall, dynamics of the Indian economy, the fundamentals point to a continuing trend of growth. And the second thing is whether that growth will require capital, right? Unless we miraculously invent a way where growth can happen without any infusion of capital, I think there will always be a play for growth capital. But having said that, will that be an open party where everyone's invited and all drinks are in the house? I don't think that's the case. I tend to take a slightly different point of view that there is a tweak required, and that as we speak now, that is actually happening. The laws of economics are, they are inexorable. If returns are not being made, then the market forces will force a change whether we like it or not. And it's happening on the ground, at various levels, right from the fact that there are the amount of foreign capital which is coming into the country is slowing down. You saw the fundraising situation, the number of funds which are being raised are going down year on year. Then there are changes which are happening in the LPGP relationships. Many of the things which were held sacrosanct till now in terms of the 220 arrangement and so forth are coming under question. And there are also changes in which are being brought about in the way the PE funds themselves operate. So all of these are happening, and I think they will continue to happen because it's just inevitable. That's the way the the business world works. And I mean, we can probably discuss this depending on time. But I just wanted to, kind of, the thing which crossed my mind when I was listening to the previous panel is when Ganesh was speaking, and he said that was somebody I think asked from the audience as to how he viewed the relationship with what value the investors had brought to the table when he had started his various entrepreneurial ventures. And he said that the best value that an investor can add is he doesn't derail the business, right? Now I think that is a pretty sad commentary on the value of investors in businesses, because many of you are entrepreneurs in this room, and if you were to go and make a pitch to a VC saying, I have this entrepreneurial venture, I've come up with this product or service, and the VC asks, what does it do? And you say, it doesn't do damage to you. The customer, if you buy my product and you take it home, it will not do any damage to you. I mean, would the VC fund you, right? In a similar way, I mean, it's a pretty sad commentary when an entrepreneur on the other side, he views the investor and he says, the best value they can add is not harming you or, reducing the value of the business. I think that's not something we can be proud of. And many times we tend to forget that just like you all run businesses, private equity is a business in itself. It's a business of investing people's money. And therefore, there is no business which can make returns if it is a completely commoditized and it requires no intelligence. The famous words of Warren Buffett come to mind when he says that if the shoeshine boy on Wall Street starts talking about stocks, then you can be pretty sure that the markets are going to tank sometime, right? So there's no such thing as a free lunch, and if private equity as a business has to exist, then I think we cannot just be sitting there and on our high horses and saying, okay, I'm going to write a check for the promoter and he's going to do all the hard work and I'm going to take my 2% management fee every year, and God knows if he'll make money, but if he does, then I'm going to take 20% of profit and then hope for a return. I doubt whether that is going to happen. That's not the way any business works, and there's no reason why private equity would work that way.
Thanks. Thanks for making the excellent comments. I think, prima facie we see that the panel really feels that yes, growth P is there to exist. Yes, few tweaks on the legal side, and there are few tweaks which are happening just by the way of the market demand supply situation. But yes, there is a recognition that we need to add more value than we are doing right now. So on that, Dimple, you moved from sort of growth P, fairly agnostic, to impact investing, very specific. Do you think that, what do you see as a change? Is this, do you see that this is a better model of sectoral focus vis-a-vis the agnostic model? Is it something that the market should go towards?
So let me just clear one myth over there. Yes, at Omidyar we do social impact, philanthropic investments. But an investment is an investment, and you are always looking for returns. And our philosophy is that while we, in the same book, invest for profit as well as not for profit, we ensure that the not for profit is largely to build the ecosystem to help the for profit companies thrive much better. So when it comes to the for-profit business, it's just like any other growth or VC investing. There's absolutely no change, and we have exactly the same legal nuances that we go through. We have the same term sheet, we have the same agreements, we go through almost everything. The only additional thing that we look for instead of, on top of financial returns is some kind of impact as well. So the four sectors that we really focus on are financial inclusion, education, technology, and what we call is that as entrepreneurial ecosystem or the emerging market system. But the underlying fact of the matter is there is an investment, and an investment is expected to grow, and it has to be led by the entrepreneur to take us to the next level.
Great. So you sound very clearly you gave the car example where you are basically a passenger, right? You are not really driving at all. I mean, not only that, you are really, really low touch vis-a-vis, the Arun here, and you also said that, some sort of validation is something which people do look forward to. Do you ever feel that, if I were running this business, I would do it differently, and, you feel frustrated? Have you ever felt that in any of your investments? Yeah.
Yeah, I think Ganesh's point is was very popular with the audience, so let me also add my 2 bits on it. In Ganesh's point from the earlier panel. So his point was the first job of an investor is not to reduce value of the company. I agree with Arun that it's not a very good selling point to say I won't reduce value of the company. But I think just like a doctor's first job is first to not do any harm, I think it's important for an investor to not do damage first. And obviously the investor will never do intentional damage. It's just that often an investor has a shorter time horizon, so he's in a hurry for the company to grow fast so that he can get an exit. And as a result of that, often investors force companies to grow too fast, take on too much of debt. I think that was one of the learnings from the 2007, 8, 9 vintage investments. I think by and large, investors in India have learned that lesson that trying to make companies grow too fast before they have internal controls for it, taking on too much of debt, or growing at a pace they cannot, is a clear recipe for disaster. So, I mean, I realize it's not a selling point, but I think it's important that investors also be careful about not doing damage. I think, yes, there will be points at which investors say, I would like rather do something different. And I think there is healthy friction on those points because, for example, actually on several cases, we have found that investors are the ones holding back entrepreneurs from doing things. Because, the entrepreneurs are often more optimistic by nature and investors are a little more skeptical by nature. So I think we've come around full circle now, and where investors are the skeptics in the room often, and entrepreneurs are saying, "Let me start this new business and it will work," and investors are saying, "Let's take one step and then a second step and a third step."
Okay, so I think again, both of you are ultimately saying that take a step back, let them do it, and a lot of trust. But then Arun, I mean, you said that a validation is required. Can you be more specific? What could the investor do ultimately if you have a 20-25% stake? I know we do the compliance, the audits, the corporate governance, the reporting system, a little bit more efficiency. But what can you do really to change the business? What do you suggest that funds should do for that? Yeah.
See, we are basically debating the point of high touch versus slow touch, right? And if you talk of high touch, there are two models that operate in the world in terms of a high touch, which you can see in an advanced market like the US. One is buyouts, where it is the high touch comes per force, whether the entrepreneur likes it or not, because clearly the funds are in a majority situation, and they pretty much call the shots, and if the management is not doing its job, even the powers of the fund allow it to even change or replace the management. So that is one model, and the other model where you see a very high touch kind of investing is the exact diametric opposite end of the spectrum, which is the VC model, right, where you have VCs who are basically who have run businesses on their own, and who are then active partners in the business and not just suppliers of capital. So if you look at the models of very well-regarded VCs like KPCB or Sequoia in the US, they're genuinely the whole partnership is full of ex-entrepreneurs who have successfully built businesses, right? So in the context of in India, the growth capital market that we are talking of, I think it's the VC model that we need to take a leaf out of, because clearly we're talking of minority capital. And there, the high touch or whatever, value add or whatever want to name it, it doesn't come through enforcement of agreements, or it doesn't come through, actually forcing or having a stick in your hand and saying to the management that if you don't do this, then I'm going to replace you. It's more like what was discussed, right? It is basically demonstrating to the entrepreneur, like everything else in life, where you build trust in a person depending on his competence, depending on his ability to help you out. In the same way, it's just the it's the ability of the fund to go beyond just marketing talk and actually doing something which is useful for the company, right? It could be anything. It could be bringing in sectoral expertise, or it could be helping with sales, whatever else, right? So it's not necessarily, when I say high touch, I don't mean the buyout kind of a model where you are doing everything contractually. It is more on demonstrating genuine value add through actual stuff, and it's easy to see through whether it is real. I mean, I don't think entrepreneurs are smart people, so it's not hard for them to see through whether when a fund says, okay, this is the value we bring in. whether it becomes very clear whether it's just marketing or it is he genuinely can do what he claims to do. So it's based on that, right? It is based on a mutual relationship that you build with the fund rather than something which is done per force.
Yeah, I also feel that it's much better if, whatever the high touch or the low touch, if it's clarified upfront, it becomes life a lot more easier. Coming back to the same analogy that I use, that if you go in a taxi, how many times have we, told a taxi driver, boss, tu side mein baith ja, main chala raha hu. So it's exactly the same thing. Halfway through, just because you think that the entrepreneur is not going on the right track, to suddenly say that I'll drive the car for you is
But
not
would you
gonna
not sometimes feel that, I wish I was driving the taxi, is going too slow, or driving too wild, or is taking a different route? Sometimes it happens, right?
That is different from guiding. So, and that has happened also most of the times. We always say, can you go a little faster? Can you go a little slower? Or can we take a little bit of a shortcut from here? Can we go left? Can we go right? And that's absolutely, fine. It's like a guide. But then suddenly saying that, I can do this better than you can, halfway through when, you have started already the game, knowing pretty well that the driver knows that he has to take you to the next level, I think it's going to be tough. And that's when the tears come.
But do you think there's an opposite problem where the promoters actually expect that you would, do the guidance and then you're not doing it, and therefore there is a bad press which comes to the industry, right? I mean, they actually expect that you will actually be helping them in a certain things which, so maybe are we not setting the expectations right? What do you think?
Well, yes. In fact, if you have promised that, through the ride, this is how you're going to go through the path.
No, but in an active market, he chooses an investor, right? If there is anything other than valuation, it will be typically low touch, the high valuation, or the name, the perceived value of the name. So in those circumstances, do you think that really there are promoter expectations for value addition? I think some of them we'll see when in the Q&A session. But do they really expect that as a partner you should be adding value, right?
Well, I don't know, and in fact, whenever we open it up to the audience, but as we heard in our earlier panel as well, most of the entrepreneurs saying very clearly, just give me the money and don't extract any value from me if you can't add value. I don't think they perceive as you adding any kind of value. But the fact is that you should be ready with a menu, with a bouquet of things that in case the entrepreneur does come back and say that, please open the doors to me internationally, please, wait a little longer before we exit, or, help me find a CFO, help me find this one, you should be available. And that's what is important. But beyond that, I think it's
Avinash?
difficult stuff.
So just one bit on that. I agree with Dimple. I think the one bit that I've seen investors being good at adding value, probably the one bit I've seen common across situations, is investors have seen things go wrong in the past before, so they tend to be a little more skeptical. So I think investors are, and also they're 1 degree removed from the entrepreneur, so they're a little more dispassionate about the decision. An entrepreneur is doing it himself, and it's difficult to be dispassionate about yourself. So I think investors are a little better at capital allocation decisions. Should the company enter this new business? Should it acquire this company? Things of that kind. I think that's one case where it seems again like a low-touch approach, but that's one area, one low-touch approach where investors are good. And I think entrepreneurs do benefit from investors' inputs on that.
Great. I think, we are running short on time. What we will do is we'll take a couple of questions. Yeah, if there are any questions, we'll be able to take them. Yes, please. Please identify yourself and then say the question.
Hi, I'm Yogesh, running a software company, product company. See, I shared it in my early discussion, sharing also that, having a term sheet in front of you, and then, that's a 99% part of the job which is done. And then 1% is that, are you the taxi driver? Or, that's the best way of portraying it. And if somebody tells me that, hey, you sit this side and I'm going to drive your taxi, I will say no. So, rejection happens that 1% is a moral commitment. So, where you say that in India, people are very sensitive about value system rather than the legal part. And you said it right. In your 20 years of career, that's more of the stuff that has happened. So I'm trying to understand that, yes, you guys are investing money and you're core expert of finance. We understand IP. We are core expert of product. At this point, what is the right direction so that the sentiment doesn't get disturbed and both the party feels equally valued and can go along? Because there is a lot of balance in this relationship, which is at the starting level. That's something which is I would understand.
See, at the starting what happens is, there is often a discussion. This is what maybe Seema can answer. In terms of in the basic starting, what the investors do is they have the right to change the direction. They have the right to go and sit there. They don't necessarily do that. But
no, that's what I'm saying. But why? Why they have the right to change the direction? I mean, that's something which is debatable at the first day. Yes, when
actually,
we are
they are sitting in the car, and if you're going to dive in, then I'm sure.
No, but why you?
See, if I may add, what happens is, to begin with, one you needs to have very clear deliverables on table.
True.
So if you're deciding to seek investment, you should be ready to give returns also.
Absolutely.
Now, most agreements do not talk about when the driver would be changed. Most agreements talk about if certain milestones or the business plans are not complied with. X number of franchise houses in 5 years have not set up, there is a issue which needs to be looked at.
Absolutely.
So I haven't seen where the investors actually recklessly ask for change. The changes happen after many deliberations, many repeated failures. And failures are not some whimsical thought process in the mind of the investor. It is usually based on hard numbers, the business plans that you have agreed to, or the milestone that you have agreed to sign. So when your question is, why do they have the right to do that? Because they're expecting returns, and you have agreed to that. Because you've agreed to deliver 25 franchise center in 5 years, and you haven't done that.
See, I completely agree. See, Make My Trip started, they planned 50 crores of investment. I don't know how much I'm correct. They said they will go IPO. But they took 100 crores. This was a story which I read in some book. I'm saying that these are not something which are for sure going to happen, but these are success stories. I'm saying that on the day one, when I am having a plan, I say I'm looking for 20 million USD investment, and my plan says 5 years it will be 50 million, I'll go IPO. My point is that it may happen with 15 million or it may happen with 30 million. So at this point, when the interaction or the relationship is going, you cannot come and say, means that's something which you're talking on day one,
no,
and that creates an imbalance.
No, coming back to the same, just to sorry, didn't mean to interrupt. Just coming back to the same analogy is that, if you are getting into that cab, you have to have a kind of agreement is that, the taxi is going from Bombay to Pune. As long as you deliver Pune to, your, customer, it's absolutely fine. The problem is that when you say that, oh, this, road is not working, or, it's a lot more bumpy, let me take a diversion, that's when we come in and say that, okay, now you've taken a diversion, now let's come back to the main road.
Yeah, I think there is a slight confusion in your mind between rights, legal rights, and possible value add that an investor can do, right? You're a bit confused between the two. When you're talking of things where, and that's the reason I also alluded to that briefly when I was talking, that when you're talking of things like, the investor coming in and forcibly trying to do something, to your business or trying to extract something, you're actually talking of, kind of enforcing legal rights and so forth. But coming back to the, the genuine value add kind of an issue, I mean, I would like to address that by asking you a question. Suppose you had you say you run a software product company, right? Suppose you had an option of, say, going to, sorry to use the word, some lala who has no product experience of any kind.
Very true.
Versus an investor who has made umpteen number of investments in your space, who understands the software product landscape, and who has genuine knowledge. Whom would you prefer to take an investment?
I'm standing here. I have family who can give me that money.
So precisely,
I'm not
right?
going to them.
And so when you take an investment from such an investor whom you trust,
Absolutely.
who has experience, and when he comes and then why would you take the investment and not take the other stuff that comes along with the investment, which is the wealth of experience that he brings along, right? So that's what it is. It is not merely a question of enforcement of rights, but it is really tapping into what the other intangible benefits that an investor can bring along when you take him on board as a partner.
I completely agree, and I think
thanks.
Makes sense.
I think that makes an excellent point. Is there
just one more point on that? Sorry. Already several answers on this question, but just one more answer to that, which is that if you rewind to early stage investment, because you see the relationship between an investor and an entrepreneur most clearly at that point, at a very, let's say, a business plan stage investment, you see an entrepreneur coming in with an idea and energy to execute on something. You see an investor bringing in the money. they are in a sense two equal partners. Maybe they don't have equal stakes necessarily. One has a little more, one has a little less. But they're two equal partners. I think that's really the genesis of the relationship. You have to say that though it could be that the entrepreneur has a higher stake, conceptually from a soft aspect, you're both really equal partners in a way. And I think both sides have to see it that way. I think that resolves a lot of these questions. If you were a silent partner in a case where you had no control, you would naturally want certain protection. If you were not running it and you were on the other side sitting quietly with no control, you would want certain protection, which is what often investors want.
Yeah, we have one last question at the back.
We are a VC-funded company, and I just wanted to share something. In both the last session as well as this one, it seems like there's something wrong between the entrepreneurs and the VCs. And I just want to share that from my experience, personal, as well as I have at least 10 or 15 other friends who have raised VC money. What I can tell you is actually the scenario is not that. I mean, I think we probably dwelt a little bit more on the negative sides. And on the value add side, there are a few value adds which sometimes, like our market is US. So sometimes we feel that if we had a US investor who had a local presence, might be they could bring in certain kind of value. But even if an investor cannot bring in that kind of direct value, I just wanted to share there's another kind of value which kind of comes into the company, which is not always very obvious, and that is a kind of discipline and governance in the company. Imagine if you have to grow up where you don't have a dad and mom. I mean, you can still grow up and you can become very successful, but if you have dad and mom, there's something which kind of controls, and sometimes it can go against, and sometimes it can go for you, but sometimes by just having them, it adds some different kind of value apart from those direct values.
So thank you, sir, for the kind comment, and on that positive note, I think we'll end this panel. Thank you, my panel members, for your excellent comments, and the audience for being so patient with us. Thank you.
Thank you, Shamil. It's been a great session, and we are ending on a very right note. Two entrepreneurs who are vouching for venture capital. You can't have better. So I kind of take back my original thing. Private equity and growth capital is very much alive. Thank you.